Joining us in the studio, Sarah Shahab. Are you a commercial property investor?
After talking to many people, I knew I wanted to get into commercial real estate, but I knew nothing. I own a pharmacy. I own a couple of pharmacies from partnership. I actually liked that I could be self-employed.
Okay.
So that was one of the reasons why I wanted to be a pharmacist, but I wear a hijab, and I did that in the late 90s, and I couldn't get a job. So I spoke to Scott, said, look, this is my situation. Just leave it with me. And I think in the week or so, he was sending me emails. Waterloo is a 6.1% return. This is the lease. This is the strata report. So every time I had a question, it was answered.
What's going on with the market?
We're talking strong double-digit returns.
Yep.
Industrial, interesting stat. We've now fallen as much in value as we did in the GFC, which is significant.
Now, I'm getting harangued by the way I start my podcast recently, and I've been advised that maybe I should tone it down a little bit with my nasally Australian voice. But this is a podcast around commercial property in Australia, so I'll say g'day. How you going? The co-host of Inside Commercial Property, Phil Tarrant, joined again by the founder. This sounds very important. Founder and managing director of Rethink Investing, plus all the other rethinks these days, Scott O'Neill. We're back in the studio. Scott, how you going?
Yeah, good to be back, mate. Highlight of the month, seeing you chatting across the desk.
It's a bit sad, isn't it?
Bleak times. But,
it's so funny how these things sort of wrap up into each other so quickly. It feels like we just got together and I'm going to go, so what are we going to talk about this time?
It's a rush these days, isn't it? Trying to fit it in. But yeah, look, it's an important part of the business and what we do, and everyone seems to like it. So yeah.
Why not?
Why not?
We got a lot of listeners, and I get a lot of satisfaction when I personally get feedback about it. This is not a show about me or really anything to do with me, but for some reason people think I know a lot about commercial property. I'm happy to report that that's not the case. I'm good to talk about it with Scott O'Neill. But I saw a post the other day, and I want to make sure I get this right. Something about how much commercial property your businesses bought. And I was chatting to someone the other day, and I couldn't remember the number, but it was a pretty big number. What was it? How did you frame it? Is some percentage of commercial property under a certain amount of value or somewhere or other? Do I get that right?
Yeah, so we got some analysis because most of our prices are sub 10 mil.
Yeah.
And we look for tenanted. So we wanted to find out roughly how much we're purchasing versus the market. So we did a data catch with Real Commercial and commercialrealestate.com, checked how many unique listings there were in that specific price point that were tenanted. And there was a couple of thousand basically each year. It peaked 2021 and dropped off a little bit the last 2 years. But using our volume, which we're in the 400s, we're roughly getting about 17 to 19% of the total market. So significant numbers. Like the only caveat on that is, yes, we buy a lot off market. So there's a lot of off market transactions you can't capture, but it still kind of highlights the influence we do have. We are buying almost 1 in 5 properties if you count all of our properties on market, but again, we're 60% off market. So it's not the truest comparison, but it gives you a picture that there's not much stock in this space. That's my biggest takeaway. Like I know how many deals we're doing. We do sort of 40 odd a month or 35, depending on the month, but there's just not much out there. And you compare that to residential, there's a reason there's so many residential buyers agents. There's 10, 20 times that volume. So naturally, there's more.
So would you look at most commercial properties that get listed in Australia? You'd look at most of them, like just the listing, nah.
Easy.
Yeah, and you guys reject most stuff.
Yeah, we'd look at every deal within 2 hours of it being listed because we've got locals. So we've got guys in Perth. We've got Brisbane covered 6 times over. So that means there's sections of Brisbane where they're divvied up. Sunshine Coast is one of them, Gold Coast. So you see it listed, keep refreshing the page, and then if it looks good, we jump on it within the hour, try to secure it for a client. If not, we just let it go through to the keeper. And most gets rejected, obviously. And we don't look at the vacant stuff. Having said that, we do the odd vacant deal if we know we could tenant it during due diligence. But it's pretty easy to cover the stock because there's not that much.
So it's a significant weight of influence you do have now. I saw that and I went, really? I knew it was big, but
in that price point. So
in
remember,
that price point,
all the big boys and the fund managers, doing the $100 million deals, that's a whole different ball game. So a lot of the volume gets done, or not even the volume, just the dollar amount, the quantum amount gets done in those price points. And there's just not much in this space. And we've got a very good market share, pretty unchallenged at this point. There's lots of smaller buyers agents out there, but they would be 4 times.
And I know you know, and we spoke about it a couple of months when we got together, that you just don't do commercial stuff. You also do resi, but you know, you've really found your sort of home inside of the commercial space, which is cool. But yeah, it's good to see the weight of influence that you guys are developing, but also the attitude and aptitude towards commercial property growing and evolving, moving forward. You know, something I've been talking about on podcasts all over the joint. I don't think the term, and this is something that's to work on, and we're not going to solve this right now, but I don't think the term, it gets bandied around a lot in the resi space as in, they're mum and dad investors. You know, there's a big debate at the moment around negative gearing, and you've got the Greens sort of beating it up and talking about evil property investors gouging the tax system and all this sort of stuff, right? But there's this sort of political sort of rationalisation that these are mum and dad investors. That leave them alone, they're mum and dad investors. I don't think it's right in the resi space. They're not mum and dad investors. They're small business residential accommodation providers, right? That's what they are. It's not like mum and dad, doctors, teachers, nurses, police people. It gets mixed up, right? You've got to say it as what it is. They're small business people who operate inside of real estate, and therefore they claim legitimate deductions for running that business, and they provide short-term rental accommodation.
And we need them more than ever. There's a rental crisis, and the government's not supplying the properties they need to, and looking at all the DAs and in construction process, they're never going to keep up with the immigration levels they've allowed.
Well, it's not a problem. I was only reading the paper today that the fact that post-COVID now that there is a propensity for people to want to live in larger houses with less people. So they're saying the shortfall now is from 2.8 people in a house in Sydney back to 2.5. Just that gap now means they've got to find another couple of 100,000 properties just for the gap. But that's not what today's about. What I wanted to ask you was, if residential investors aren't mum and dad investors, but they're small business people that run rental accommodation, you operate in that sort of sub 10-ish million price point. This is where I wanted to get to. I don't want to call them mum and dad investors in investing in commercial real estate. They're small business people who are providing office, industrial, boutique specialised commercial accommodation for Australian businesses.
Yeah.
I want us to work on this. And I think we've got to try and use this as a platform to reshape the attitudes towards investors in that way, particularly with commercial, with this podcast.
For sure. And that's a good point. One thing I wanted to bring up with residential is the market has changed a lot. So the minimum price points, because we get, again, 50 to 100 people reach out to us per week. A lot of them are only suitable for residential property.
Yeah.
But the entry-level price point now is somewhere around 500 to 700,000 for a decent area. Sure, you can go out to the middle of nowhere and find a 200K dump. But that's, if you want quality, 5 to 700K.
Is that a technical term, dump?
Yeah, very technical. But it's now not that entry level. You need about 100K deposit to get into a decent residential property. So it's getting expensive. So where we sit in the buyer's agent landscape is we work with those entry level guys, which is about 100K. But our specialty is dealing with the people that have got to that next level, and they're often business owners. Maybe they've had a great run in residential property and they want to kind of diversify or take a cash flow priority for the next 5 years to replace income. And that's where the commercial space is. And it's minimum 200, 300K cash. And then, the best investors, dollar for dollar, tend to be $1 million deposits. And it keeps going. So if you come to me and go, I've got 1.5 mil cash, I know I can get you a great freehold deal, potentially upside, 6-7% returns, good capital growth. You'll have it all. The cheaper deals have more risk. So it's very important to note that, and that's why we're quite specific. Maybe sometimes it's not always the right thing to go into commercial in those entry-level price points because you're just going to deal with smaller tenants. And sometimes the old residential has a better place for you.
Yeah. Well, last time we got together, Scott, I gave you some homework. And last time we got together was International Women's Day, by memory. We had a great guest in the studio. And I said to you at the point in time, maybe on air or off, I can't remember, I said, we need to get more female investors into the studio because this is the quiet hand of success in Australian real estate, and they don't put their head above the parapet. They go about doing their business, and they do it very effectively, and they're not out there looking for the big headlines. But I said, I want you to go out there and I want you to find some really capable female investors come and have a chat to us around investing in commercial property, and you have done that. So you're very good at your research and your and thank you for doing it. In the studio joining us today is Sarah Chehab. We're going to introduce her in a moment, but just very quickly, welcome, Sarah. Sorry, I'm just gibbering on the Scott for a little bit before we sort of uncover your story, but thanks for joining us today.
My pleasure. Thanks for having me here.
Before we go there, what's going on with the markets? Tell me. Well, summarise it.
All right,
summarise the last month in 2 minutes.
Resi real quick. Top markets, Perth, Brisbane, Adelaide.
Tell us something we don't know.
Yeah, you already know that.
Okay.
You're pretty across that. But you're talking strong double-digit returns. The higher price points are a lot more subdued. Naturally, interest rates are affecting those more leveraged, higher value markets, lower yielding too. Industrial, interesting stats. Job ads are still 70% above pre-pandemic levels. Vacancy rate 2.4% now on the East Coast. That's up from 1.8% in September last year. So we're seeing the vacancy rate creep up a little bit. Remember, it was down at 0.6% for quite a while. More supply is coming to the market. Basically, the tenants are still there, but there's just more profit in it for some developers. So there's, basically stuff getting released. But the biggest stat is transaction volumes are still about 39% down from where they were last year. So there's not much. And highlighting that kind of table we were talking about, the theme is there's not much to sell because sellers don't want to sell this stuff and buyers are fighting over minimal stock. So that theme will continue. I think even when rates drop, it's going to give sellers less reason to sell. So all that kind of spells a bit of a period of good capital growth ahead of us. If interest rates drop significantly, people are going to get excited and pay more. If they stay high, it's just going to be a bit of status quo for quite a while, which the status quo is good right now for commercial. Like, it's still growing. We just need this rental growth happening at the moment. With office space, interesting stat, we've now fallen as much in value as we did in the GFC, which is significant because the GFC was it was the worst case event for office because obviously it's hitting the banking sector, the leverage, all the funds got punished. So the fact it's fallen the same as the GFC rather, that's big news, I think. So I think we're going to see we're close to the bottom now in that market. Huge amounts of talk about converting offices into, anything from other types of commercial to residence to education centres. That's looking good. Retail's pretty flat and stable. Massive demand for things like supermarkets, not so much demand for high-end restaurants and stuff like that. So it's a mixed bag, but overall it's busy and we're seeing the volume trend up. So at Rethink, we in March we did 40 transactions, 73 million in total. That's one of our better months. So we're seeing more connection between sellers finally coming down on price because they had their heads in the cloud for a lot of the time, but they're coming down more this year. So that means yields are a bit better and investors are taking the opportunity to transact. So overall, pretty happy.
So worst case scenario, just steady as she go, continuity in the market.
Worst case scenario is they don't drop the interest rates. Some people are pricing them in. Obviously we had Nerida in the last podcast. She's pricing in 3 rate cuts. Some new data came out last month suggesting that it may not be as much, but they're still factoring maybe 2. That might turn into 1. Who knows? It's all at the beck and call of the next data release. But that's the worst case. I think it just doesn't go down and people eventually hurt a little bit more. But from my experience, people that have the money are still comfortable. And those that are hurting, they were hurting 12 months ago.
Yeah, well, you only need to look at the inherent sort of resiliency of the Australian economy. That despite a lot of these sort of economic headwinds, you've still got unemployment has dropped, and you've got jobs growth sort of rising. So that's intrinsically connected with commercial real estate. So
exactly,
that should hold the floor at a worst case scenario.
I think so. So outside of random CBD office markets, like the worst being Melbourne secondary office, that's 19.2% vacant. Okay. The best office market is in Brisbane. the premium, it's only 6% with 13, and it had 11% rental growth. So some of the office markets are already recovering quite strong.
Is that a normal market, 6%?
I'd say about 7, 8 is.
Okay.
So that's a strong market.
Yeah, okay. Wow.
It's higher for office due to just the amount of stock and aging stock sits on the market.
Yeah.
It always will.
Okay. Well, there you have it. A quick rate. If people want more from people can just call you guys up and sort of ask you what's going on.
That's our job, to understand the market. So we want to place clients into rising markets, not ones going down, because there's always a different market to choose from. So
there are good markets irrespective of market conditions.
In this case, yeah. I'm sure there'll be again, an event where everything goes down, but that's the period you buckle down and see it through. Because as long as you hold through that worst case period, you generally won't realise your loss in property. Just hold through, and 3-4 years later, you're back to the good part.
There you go. Okay. Well, thanks for sharing those insights, Scott. I know it's you do that very quickly and briefly, but there's a lot of experience there and a lot of sort of reading. I know you're a bit of a nerd. It's your engineering background. You probably immerse yourself in this stuff. So being able to synthesize it in a way that I can understand it means that I reckon most people can understand it. So thanks for that. But you have very different client base, and it's a real privilege to get to meet a number of them as your organisation continues to expand and evolve. Even outside of just the commercial property stuff, you now have a number of different arms to your business, which I'm trying to keep across. One of them is your new education capability, Rethink Commercial Education. We'll have a little chat about that today. But joining us in the studio, Sarah Shahab. How you going? What's going on?
Nothing much.
Nothing much. Getting by. Are you a commercial property investor?
Yes, I am.
Is that what you are first, or there's something? You're probably a mum first and a commercial property investor second?
I'm a pharmacist.
Are you a pharmacist before
yes.
you're a commercial property
correct.
investor?
I've
Okay.
been a pharmacist for about 25 years now.
Yeah.
Yeah.
Are you still a pharmacist?
I'm still a pharmacist.
So you work in a pharmacy?
Yes, I work in a pharmacy. I own a pharmacy. I own a couple of pharmacies.
Okay.
Partnership, yeah.
That's very cool.
Yes.
I hear they're a license to print money.
Probably in the olden days, but definitely not now.
Not now.
No.
Do you have one of those local pharmacy where there's a couple actually where I live, but one of them sells lottery tickets now. Do you sell lottery tickets
Absolutely
yet?
not. No.
No, you haven't done that yet.
Well, we sell marijuana.
Like the real deal stuff, right?
Yeah, the real
Do you get
stuff.
people coming? Oh, can I get a script? It's like,
They've got to get the script from the doctor.
Yeah.
Of course. But now the kids say their mum sells pot.
so you're a legitimate
Drug dealer.
the local. Where are your pharmacies?
One in Arncliffe and the other in Rockdale.
Okay,
Yeah.
all right. I'm sort of familiar with the areas.
Yeah.
Like a sort of high street type stuff, pharmacy, that sort of thing. Yeah.
Proper it's prescription. You got to see a doctor, of course.
Yeah.
And they're all kept in the safe.
How much stock do you need to hold in a pharmacy? Like, does it age quickly? It's always curious.
It's just
or do you
like
get it on
any-
consignment? You sell it? I don't know.
No, it's not consignment. No.
No.
You just you know the number of scripts you get per day, and you get familiar with sort of medications people are on, so you know what to keep and what not to keep.
Okay, and what's that new Osme thing that people that weight loss drug is that?
Ozempic.
Yeah. Is that popular?
Oh
Is
my
it-
goodness, it sure is.
Is it?
Yeah.
Like people they're writing heaps of scripts on it, are they?
Oh, there's just been a stock supply issue. So,
Okay.
And it's really only should be used for people with diabetes.
Yeah.
Yeah.
But it's not been used for that. So anyway, I don't know. Anyway,
Well, people have weight issues.
They do. That seems to work for some people.
And
but,
it does adversely affect their health. So
Yeah. Well-
there is a place for it.
So what do you most like about being a pharmacist?
The access to the medication.
It's pretty cool. But,
Yeah.
so
Jokes aside, no,
Yeah.
I enjoy, especially during COVID, we're the first point of call for people that had health issues. They couldn't see their doctor. So I vaccinated thousands of people during that time.
Oh, so you're doing the vaccinations.
I did the vaccinations and just honestly just being on the forefront and being able to help people is, I feel like, gives life some meaning.
So from what I understand about being a pharmacist is that you generally got to be pretty smart at doing it. How did you sit there at year 12 of school going, when I grow up, I want to be a pharmacist? How did you end up doing that? Because you got to choose it's university education, you need to be pretty intelligent.
I knew I wanted to, when we did the HSC, it wasn't do what you love back then, it was do what your marks told you could do.
Yeah, okay.
That generation.
Yeah.
And being first generation Australian, that's sort of what happens. So I got the HSC marks for it, and I actually liked that I could be self-employed.
Okay.
So that was one of the reasons why I wanted to be a pharmacist. Obviously, being in the health, I enjoy helping people and being in the health sector, but being self-employed and being able to work at a job that I could leave at work. So whereas accounting or law or other things, they take a lot of work home. Whereas I can
You shut the door.
I mean, there are paperwork things I have to do, but it's my working hours are during my working day.
Yeah.
Yeah.
And so you get a degree, you probably worked at a pharmacy for a bit. How long between working for someone else versus starting your own pharmacy was there?
I think my trajectory may have been a little bit quicker than most.
Okay.
You probably can't tell in the podcast, but I wear a hijab, and I did that in the late 90s, and I couldn't get a job. I went from someone before I wore the hijab to be able to rock up to an interview and get a job immediately to just not being able to find work. And they would tell me, if you take that off, that's fine.
So even in the areas where, because, there was areas of Sydney in the 90s where hijabs were pretty commonplace.
Not really. It wasn't as, maybe there weren't any jobs available then in Lakemba and that, but not where I was living at the time. So, I mean, I did find some locum work here and there, but it was hard. And so I figured the best way to be was self-employed.
Be my own boss.
Be my own
then I have to
boss.
worry about
That's it, yeah.
Yeah,
So,
that's super impressive. How'd you get started then? Like, that's a big deal.
Yeah, so I always, as I said, like I'd gone into university, I did pharmacy. Again, one of the reasons why I did pharmacy is I also wanted to be a stay-at-home mum as well. So working part-time, being able to work part-time, having flexibility was important for me. So, but I knew I couldn't be a full-time stay-at-home mum either. So I got to know another pharmacist, and we were doing something called medication reviews together, and an opportunity to buy a pharmacy came up, and we bought that together, and we were both able to raise our children were young, and we both worked part-time, and
So you sort of job shared?
we job shared.
Yeah. So you bought the pharmacy, or did you buy the business and also the building?
In terms of pharmacy, it's just the business.
Just the business.
We don't own the freehold.
Yeah. Okay. Yeah. All right. So, oh wow, that's super impressive. And this is late 90s type of.
Yes,
yeah.
early. I bought the pharmacy in 2004, March
Okay.
2004, so 20 years.
Yeah.
to now.
So mum first, pharmacist second. So commercial property investing is the side hustle.
That's correct. It's just in
Okay.
the last couple of years. Yeah.
It sounds like a pretty big side hustle from chatting with Scott. How long have you been working with Rethink for?
A few years, couple of years.
How'd you find these guys? Just stumbled across them?
No, well, I got divorced.
Okay.
Yeah. So, and I ended up with about I had 100,000 in my super, and in my superannuation, I realised I'm in my mid to late 40s. I don't want to be working forever, and I can't retire off this. And I had residential. I did have an investment property, and it just wasn't bringing me much rental income into, and I knew I couldn't retire off that, and I couldn't retire off my superannuation either. So I knew the best thing to do was to perhaps sell that, and but what do I do with that? What is the best next step? And it was through word of mouth, if you recall, and I got in contact with Scott, and the rest is.
There you go.
There we go. Yeah, here we are. Yeah.
So how long from having a chat with Scott to doing something?
It was honestly immediate. So
What was
I was after talking to many people, I knew I wanted to get into commercial real estate, but I knew nothing. So I was looking at the apps and commercial real estate apps, and going onto Burgess Rawson, and I was trying to. I went to one auction at the Opera House, and that fell through. And it was 6 months, and I had sold the house, and the money was just sitting there. And I was speaking to a friend of mine, and she said, look, her husband, and he said, I know Scott, and I recommend you speak to him. So this is 6 months later, and the money's sitting in the bank. And I gave him a call, and I told him, look, I went to auctions, it's not happening, and I'm scared because I don't know what I'm looking for. I don't know. It's different to a residential house, that it's got to be near public transport, or you don't want a drain in the backyard, or you don't want white ants in your roof. But what are you looking for in a commercial property? Well, what are you not looking for as well? What do you not want there? So I spoke to Scott, said, look, this is my situation. Just leave it with me. And I think in the week or so, he was sending me emails.
Yeah, I remember talking to Sarah, and it's a classic first move. You go to those auction houses, and like you were talking about the yields, and this is solid price points, like 4 or 5 million. And they were talking like 4% yield for this childcare in regional New South Wales, and like alarm bells are ringing because that's the classic trap. People go, oh, there's a 15-year lease. We don't know much about the operator, by the way. It's just a 15-year lease. And then you're overpaying by probably 20%. So on a $5 million price point, that's $1 million potentially overspend. And I just explained that and said, look, you can definitely get much higher yields with more safety potentially, or a diverse income if you split it up a couple of times. And I think that resonated as well. And I always say, just let the deals do the talking. We can talk hypotheticals all day, but at the end of the day, you need to see what you're going to buy and understand that business and the location. And within a few weeks, we got this off-market deal. It was direct from a developer in Sydney. It was a fund manager actually that developed, and it was a supermarket in Waterloo. And big long lease on it, great operator, and 6.1% net return. And I'll let Sarah explain what happened after that. But yeah, there was plenty of upside with car park income and stuff like that.
Well, I know Waterloo. You're not going to go too wrong with people needing food in Waterloo.
I was still tentative. It's still a scary step. But I know I had a buyer's agent, and I knew that they did the due diligence and things like that. So I was comfortable with Scott. I had met him, and he had all the numbers out there. So there wasn't anything that made me think I could be scammed or this or that, because you do when you're fresh out of a divorce, you do worry about these things. So and I'd almost I had gone to another commercial agent before you. I don't know if I told you this. So as I was looking at buying land and house packages, or anything. As I said, I didn't know what I was looking for. And then she had introduced me to this land and house package, and I said, hold on, I've been reading a lot about building companies collapsing, and people are buying land and house packages and their houses can't be built. And she was really trying to get me to go that way, and thank God I didn't, because a friend of mine did. And a year later, I didn't realise she was with them, but I hadn't met these people through this mutual friend. And she was telling me how she's been through a nightmare, the builder's collapsed, and she's now having to finish this build on her own, and it's in country, and she doesn't know what she's doing. And, I dodged a bullet there.
It sounds as though you weren't chatting to a buyer's agent. It sounds like you're probably chatting to a project marketer whose job it was to sell you house and land packages.
Yeah.
So, and this is a key point for our listeners out there. There is a huge difference between buyer's agents who represent the buyer, Scott, for example, who you pay to do the work, versus someone who's probably getting commission for selling.
Yes.
Probably too, but the point is that by engaging people who are smarter and more educated, like I wouldn't give myself a script and give myself drugs because I had no idea about it, right?
Yeah.
Much like I don't buy property myself because I know a little bit about it, but so I actually build out the capability and a safety net of having people in those capabilities. So it's smart. Do you mind me asking how old your kids were when you were divorced?
2018.
Okay.
Yeah, so 21. Yeah.
So sort of they were on their way to. They weren't young kids.
No,
so
they weren't.
yeah. So you're sitting there going, okay, well, I've got to sort my stuff out.
That's correct.
To
yes.
prepare for optionality and choice into the future, whatever that might look like.
I knew I wanted to be independent, so I didn't want to be in a situation where I was relying on a pension or relying on children. My independence was very important for me.
Yeah. So would you, if you had to sort of benchmark yourself now against where you were at that point in time and this sort of soul searching and thinking about it versus where you are today, do you feel independent? You've got that capabilities of independence. If you stopped doing anything now, you'd be right? You'd be good?
Yes.
Okay.
Yeah.
That must be quite a comfort.
It is. It is.
But does it mean you want more though now? Have you got
It's
have you got that sort of
Do I want more?
Yeah.
Look, you do think about your children and the future and their capabilities of buying their own homes. And as we mentioned earlier, I am a mother first. So I do want to be in a position where I can help them. And I have an ageing mother as well. So I want to be able to help them so that they could buy a home, get settled, because it isn't what it was like 20 or 30 years ago when I was able to buy my first home. Yeah.
And it's, again, a real privilege to be able to have that choices available to you to actually do that through property,
Absolutely.
But you've done it through your own decision making, your own, blood, sweat and tears, right? You've done something, whereas a lot of people will sit around and want it. What makes successful investors people that go out and do it. And it can be hard.
Yes, it's scary. It's not, and you've got to trust as well. So I trusted Scott, and
why did you trust him? What was it that sort of engendered trust? Was it immediate trust?
No, I think it's because I was introduced to him through someone.
Okay.
But I think him, as you mentioned, he was an engineer, so he came to me with facts and figures. What was it? Waterloo, the 6.1% return. This is the lease. This is the strata report. As you know, between 2004 and 2019, all these shoddy buildings went up. So I was also afraid of buying into a shoddy building. And it's like, no, Sarah, look at the strata report. But what's that? Like, I wasn't even familiar with how that happens. And he goes, this is the strata report. We do due diligence. We look at this. We look at that. So every time I had a question, it was answered. And that built the trust. There wasn't anything that he was hiding because everything was out there on paper.
Yeah. It's good. And you've got to trust your buyer's agent, right?
Yes.
Like you've got to trust your mortgage broker here.
That's right.
And a lot of people are uncomfortable sometimes with property investing, because your accountant, like you got to bear your nakedness, your financial nakedness, if you want to call it that. You can't sort of hide things away and don't tell them about it. Like you got to say, here I am, naked.
Yeah.
This is everything about me. Only then they can really help you, because if you don't give all the facts, they can't make an informed decision. And we need to remember we're paying these experts to set us on the right path. And a lot of people aren't very comfortable with that.
No.
It's funny. People are becoming more comfortable with it, I think, but they're still is it a fair call? Do people sort of still go, oh, don't want you to know everything because, don't want you to see too much?
Yeah, look, especially some of the ultra high net worths, like they'll say, oh, I've got 5 mil and really it's 20. And they just sort of trial you out for a few. But I find they're all fairly open in general. Like, because at the end of the day, like, we're working together on this. Like, most people don't have financial planners. Like, that's more of financial planners are a little bit more basic than what we look at. Like, they don't often understand the commercial markets because they recommend stock portfolios and insurances. So this is a different ballgame. So most of our clients are generally self-made to a degree and very curious. So Sarah, great example. Like, she asks a lot of questions, but they're all very good, and she learned through the process. And we negotiated due diligence clauses and stuff like that. So she knew she had a way out if things went wrong. So made a decision, but was very critical in every aspect of the property. Like, we went on site, we walked around, we tried to analyse what would happen if this supermarket went vacant. We could split it in two. We checked the square metre rates of the neighbouring properties. We identified there was some upside there. There was some car parks in a extremely valuable part of Sydney. The building was rock solid. We went there at evening to see the foot traffic. We went in the day. We did the DD, basically. And Sarah made her own call after that.
Yeah, and this too, once you buy a lot of property as you do, and I've bought a bit of property, you get a level of comfort to understand the process. And, if you go, let's go ahead, you build in so many ways to get yourself out of something without any real financial compromise. And that's part of the game, right? That's part of the effectiveness of being a really good buyer. But again, it's through education that you get that level of comfort. Do you like clients who are curious? I imagine the best sort of client is a client who's curious but also coachable. Yeah,
look, the more knowledge, the better. Like, there's sometimes where they've got so much knowledge on a specific area. Like, I'm dealing with one guy now that deals with storage. He builds them. He knows that's his entire business. So, there's not much value we can add in terms of introducing, besides our networks, which are vastly larger than his, but we can introduce these sites. He does the DD because he runs hundreds of these things. And then they're a little bit harder to work with because we can't spread our wings and look at other asset classes as much. Because I like being an open book. Like if Sarah said no to that supermarket deal, I wouldn't have blinked. I would have said, that's fine, next deal, let's look at it. So and that's maybe part of the trust. I don't care.
So you thought it was a good deal?
Yeah, and look, I would only present a deal to a client that I'd buy myself too. And it's just there's so much choice out there, despite the low stock. It's just a matter of time before you find a new deal. There's no point going into a deal just for the sake of it. So I like that deal because it was 2 titles, great part of Sydney. It was all fully let around there too, and there was about 10 stories above it, and they're all just coming down and using that as the local, because they didn't have cars and stuff in that part of Waterloo. So.
I think I can sort of visualise what. Can you give me a sense of the deal? What was the purchase price? What's the sort of?
So we put it under contract for $4 million, and we ended up getting it for 3.8 with some tweaks in the outgoings and negotiating down the track. So 6.1% return, which was great in Sydney 2 years ago. And that's, what's it now, Sarah?
So it's up around 8% return now.
It's pretty good going. Yeah. So 2 titles, a couple of car parks.
And I remember, and why I would recommend a buyer's agent is, you said 4 million. I think they even wanted perhaps 4.1 or 4.2. And then Scott said, let's offer them this. And I thought, that's embarrassing. And he did it. And they actually came to the table. And we reached a price, and through their due diligence through Rethink, they're like, there was this that wasn't taken account of. And therefore the return of the rate of return, what do you call it?
Reverse yield, calculate it back to what we should have got.
And got me another $38,000 discount.
Pretty good.
Yeah.
So you've got debt on the investment?
Yes.
Yeah, okay. And how's it sort of sit once you finalise your P&L each year? Imagine it's positively geared to some extent, even though there's interest rates have gone up quite a lot.
Yeah, I'm cautious.
Yeah.
But what I did do is I borrowed more than what I needed.
Okay.
And I did that on purpose.
Inside your super or outside your super?
Outside my super.
Outside the super.
Yeah. So super, I just didn't have enough in there. So I've put that in a trust fund.
Okay.
So that's with my children and I. And the super is something I'm working on separately. So when you ask me probably what's your future goals, my goal now is just to increase that what's in my super, and eventually buy commercial with that. Inside
of your super fund. So you're maximising your contributions into your... And where are you getting that advice from? You got a good accountant and stuff who are sort of helping you out with all those things?
No, I think just reading and...
Education,
yeah.
Yeah, they reckon like if you stay within the parameters of caps inside your supers are really tax effective.
Absolutely is.
Self-managed super is a really tax effective way to create wealth, particularly if you're buying real estate assets. So you've got a supermarket in Waterloo in Sydney. Yeah. So what happened after a supermarket in Waterloo in Sydney?
So as I said, I'd borrowed more than what I needed against the surprise of many, but I knew that getting money off the banks is always hard.
So the banks were happy to lend you the money, no worries?
Yeah.
Against the assets or against the business?
It was because I'd sold.
Okay, all right.
Yeah, so I had a deposit,
cool.
But I borrowed more than what I needed.
Yeah.
So I thought I was going to buy, I borrowed more than what I needed because I wanted to buy like an apartment or something for my children. And then using Rethink, we were looking at apartments and things like that. And then I had do you remember that? We had and they were quite happy. It's not like they charged me extra. It was like they spent a good month looking at apartments and going through and trying to help me find an apartment that would be good for my kids and things like that. Then I had a conversation with Scott and I said, listen, Scott, if I wait a year, I can perhaps buy another commercial property. And even though they had invested all this time trying to find me a residential property, he was quite happy to say, okay, I think I do think buying another commercial property is better than buying an apartment, and let's wait the year.
Okay.
So he did, and then he found me the next commercial property.
Patience is probably one of the core skills of a successful investor, isn't it?
Yeah, and look, there was a part of me that was a little like, it's very hard when you get a brief that's emotional. So obviously looking for an apartment for a child is...
Was this for your kids to live in, was it? Okay.
Outside the investment game. So that's not what I specialise in. So, but in my head, I'm rattling through the idea that, is it the best idea because you've got to pay your strata, maybe that apartment's not the best thing for your child forever, because I'm a big believer, I don't like trading up too many times because you pay stamp duty and sales agents multiple times. So we were looking at one-bedders, in the middle ring suburbs of Sydney, and they'd still, $1 million type stuff, and highly negatively geared and oversupplied markets in some cases. But we went with it because it's helping the client, and physically inspected and made sure it was a good building. And I was glad Sarah somewhere along the journey worked out maybe building a cash flow surplus will provide more security for my kids down the track, because that's how I think. If I can leave them with passive income, they can choose to sell off the assets or use that income to leverage off or whatever. But if they've got that one house, that's all they've got. And they probably may not want that when they're 40.
That's right.
That's the normal summary of that situation. So they end up selling, paying capital gains, and then you've got to start again and get back in the market. So, I was glad Sarah came around to that.
I think I might buy another commercial property. Oh, okay, commercial property is pretty good.
But it meant that he was happy to forego that capital that he did spend on me, helping, or because it's not you had a division. Now, Sarah, you are making the right decision. Wait a bit and let's buy commercial. And that was, and as following with what Scott said, that was the whole reason why I got out of residential investing, because if you've got an investment home and you die and your kids inherit that, they're paying capital gains tax on what you paid for that. And on top of that, the yields are low, you're paying insurance, you're paying land tax, you're paying council rates and all of this stuff. Whereas through Scott, I was able to buy commercial properties where all these outgoings are paid for and the yield. Residential gives you capital growth, but capital growth isn't going to help me at all when I retire. I can't live off capital growth. That's not going to give me an income. Yeah. So that's why I wanted out of the residential, because I wanted cash flow, not capital growth. And giving that to children when I do pass away is, I think, it'll cause a lot less friction, because they're looking at an asset that they can keep in a fund and live off the income of that.
Yeah, and there's pros and cons, and this doesn't constitute financial advice in any way, because I'm not qualified to do that. Yeah. Speak to your accountant, but there are pros and cons to investing inside a trust, and one of them is obviously estate planning, particularly if you're buying what will be in time or already be positively geared assets. It's a great enabler for generational wealth. So if you had to sort of put in a hierarchy your strategy, obviously, to create wealth, it's how you choose to deploy that over time is where the choice is. But when you make your decision making, how much of it is you want to be comfortable in retirement versus you want some sort of financial legacy capability to give to your children versus being in a position to look after an aging parent? How do you sort of give sense to those different forces to help you with your decision making on it?
I think first and foremost, I'm going to be a little bit selfish and want to make sure that I am self-funded in my retirement.
That's good.
And I'm actually probably doing my kids a favour by making sure I am self-funded in retirement. Yeah. So that was my main goal. But I also, doing that, you still want to be in a position where you are protecting your children's wealth or whatever you don't want to be. So I just wanted to make sure that they were protected as well. So when I pass or as I age or whatever, I can help them out too. Yeah. Yeah.
And if you do the right stuff, like putting all that aside, if you buy really good properties, all those things should fall into place, and you can worry about it when you get there.
That's right.
It's if you buy the wrong stuff in the wrong entities, when you get there is where it becomes a problem.
That's right.
And this is why you really need, if you're going down this pathway, you need to get really good,
that's correct,
sensible advice around it, and the advice that suits you and that doesn't suit the person who's providing the advice to you. We do a lot of work here within the financial planning and wealth management space. But you've got to make sure if you're going down the pathway, you've got the right advisors who are actually applying the right strategies for the outcomes that you want. And a lot of financial advisors, the Scots don't really play in commercial property or resi property, right? For a whole bunch of different reasons. But it sounds like you got it sort of sorted out, you know? Sort of sorted out.
Yeah.
So you decided to buy a commercial property. Where did you buy? What did you buy?
The
second one.
The second one was in Townsville.
Okay.
And so that was hard because the banks were giving me a hard time with that one.
Mm. But they didn't like it, or they didn't like Townsville?
It was right when the serviceabilities were getting squeezed.
Yep.
And remember, Sarah was using a deposit that was on loan, so effectively 100% loan. So the strategy we went with is, number one, we need a high-yielding asset. And number two, well, there's three. I wanted to save a depreciation, so there wasn't much tax. We went with a new high-yielding industrial asset, which was Townsville. So it was $2 million and 7.5%
purchase from
net.
a institutional developer.
This was just a local operator builder who just built it, and they had some a good tenant in there, 3-year lease. But yeah, 7.5% net. It was 3-4 years old, so yeah, great cash flow. It covered the interest easily. The interest rate back then was probably about 5, like late 5s, I'd say. So getting 7%, 7.5 rather, it's a good day at the office. So it was still a squeeze to get that whenever you deal with a 100% loan. This is one of the troubles. You need it all to go right to get the serviceability. So that's where we ran into a few issues.
That's right.
But
sorted out with the bank.
Done.
So you have a principal place residence?
Yes.
And is there debt against the principal place residence? Is that connected in with this stuff, is it?
No.
Sort of in and around? Okay.
Yeah, it's not connected now.
Okay. Well, that's nice again. It gives a sense of, stability and continuity, which is really handy. So what's next for you guys or for you? Are you going to keep down this march of investing in commercial property?
I find it fun, actually.
Yeah. So you actually enjoy it? Like
I
do.
I do.
What do you enjoy about it? Do you enjoy are you connected with the outcome and the benefits of that outcome, or do you actually enjoy the process?
I think I enjoy the process, looking and searching. It's, as I said, I went into it not knowing anything, and then learning intuitively through the process, and then they were offering the Rethink course. So
I was going to ask you about that. So you've done the education?
Yes.
Okay. And what does it entail? Is it sort of onerous? Because I couldn't think of anything worse than having to look at textbooks ever again.
No, there's no textbooks.
No?
It's listening to Scott talking.
Okay.
The
dulcet tones.
He had. So I had my own loan broker for the first one, and then through the second one, I used Rethink. I used Son at Rethink, and he was fantastic, and I highly recommend him. And it was.
We've had him on the podcast.
Yeah.
We might bring him back.
Yeah, it was worth it.
Yeah.
And so it was wonderful being able to consolidate what I had learnt on through the process. Yeah.
So it's more of an affirmation that you're doing the right stuff.
And learning. One of the things was one of the things that I learnt that I put in place was that each commercial property should have its own trust. So you don't put everything in the one trust fund. So, and I was like, lucky I learnt this before Townsville. So we created a trust fund and bought Townsville with a different trust fund.
And what's the logic with that, Scott? Is that what you do personally?
Yeah, so
I hate to be your accountant.
Yeah, I just outsource everything to Josh Liddy, my accountant. He does set up new trusts each time, like land tax, security reasons, lending. There's a few reasons, but it's so specialised, as you said. You cannot just and I don't like it when clients go, "What do I do with this trust?" Because it's not
your
my
game.
ballpark.
No.
Yeah. So talk to the boss basically there, and but yeah, all the good accountants tend to give that similar advice. Like you're dealing with a large asset generally, highly cash flow, so that you got to worry about tax minimisation and stuff like that. And generally, you're over the land tax threshold too, so you don't want to keep buying in the same trust because it multiplies worse that way. So but I learn a lot even just listening, because in that course we've got the accountant Josh Liddy's on, the finance guy, the legal. There's a depreciation guide, there's an insurance guide, there's a renewable energy guide. So all of them just go deep, like way deeper than we can cover in an hour here in this podcast. And it's just consolidating it in one spot. So it was great. Once Sarah did that, she probably didn't know what she was doing, but like on the third purchase, the questions were different. Like they were more direct, very
focus.
Like harder to answer generally. Like they weren't the simple questions. They were very specific because you knew all the answers to all the other stuff. And
do you have to be a client to do the course, or you can just do the course?
No. Well, like we have other, like, you know, we have sales agents do it, all sorts of stuff. So it's anyone and everyone, and it's the third round of it, or third cohort. And
so you got to be accepted into it, do you?
we try to keep it to under 100 per cohort.
Do we try and keep it under 100?
Yeah.
God.
Yeah. So
aren't you worried you're going to create your next competition?
We are.
Yeah.
Unfortunately. But there's a greater good to it. Like, so it's actually quite satisfying, like giving away like this information, because look, it comes back. They still buy properties, and yes, there'll be other competitors, and we do bid against these clients, or not clients, they're just students, we call them, in the market. But there's a greater good. You know, there's a little bit of damage it does from a competitive point, but it creates an ecosystem for Rethink, which is quite important to me. Like, I'm not just about growing the business. I want to grow the trust, and brand is very important. So that's why we're into the renewable energy, education. We don't make money out of this education. Like, it's you know, $4 or $5 grand for a course, but the amount of hours that you put into it, and there's a lot of freebies in there, like discounts off sign-up fees and stuff like that in there. So there's a lot that kind of gets absorbed out of it, and then there's full-time staff in there. So the costs get drained quick. But again, it's the ecosystem, and like Sarah's hooked for life now, because now she's got the confidence, which is a lot better than 3 assets.
So you'd rather a more curious client who's going to interrogate your decision making as part of a process of red teaming, I guess, you know. And it means they're invested in the outcome as well, right? And you probably don't want to go, hey, whatever you say, Scott, do it.
They're responsible for their own decisions. They're confident in their own decisions. I can lead them down the right path, but I know my biggest problem in this business is helping people recognize a good deal. Because, you know, you look at your first $3 million deal, what have you ever compared that to? Yeah. I've seen thousands of those over the years. Constantly, every day it's hitting me. So I can level that, like, I know that's, top quartile, done. That's a decision, you've got to buy that. Someone who's never seen this, they've got no idea. It's just a random shop or a random shed in who knows where, Newcastle. What's that mean? Like, so, but when you compare it and understand it, you know this asset class it comes with risks. Just understand it, and then like 65% of we did a little survey, 65% own commercial properties in that course. So this is not just brand new junior, nobody investors. Like, there's a bunch of like first time investors in there, but there's some guys that have 10 plus commercial assets in there as well. So maybe
I'll shoot the course.
Cheeky
to ask for a free one. I think it's important, you know, education is absolutely critical, and only being informed can you actually make informed decisions. And it's one of the reasons why we do podcasts like this and things like the Smart Property Investment Show. Like, we get our staff to do it. People who want to become staff of Rethink Investing, like it's just fast tracks what we know. You know, it's there's about 100 videos on the thing, and every spreadsheet and every solicitor or accountant tip you could ever imagine. It's always getting updated, because like every time someone gives feedback, bang, that's a new chapter or a new thing. So every cohort is slightly better. So you come up with the 4th cohort. Third now. So how do you sort of participate? What's just rethinkcommercialeducation.com. Just Google it and you can sort of work it out.
Yeah. And we're, like, if you're on our database, you'll get emailed, but we'll do probably 3 a year. Okay. And just keep rolling it through. And I don't want to mass market it too much. It's nice having, you know, that sort of sub 100, because like you said, it will probably create more problems if you just get all these non-committed commercial investors in there. It's just another course for the sake of it. But I know the students meet up and stuff like that as well. They did. So you sort of create. So do you sort of make a network out of this? Have you got sort of school buddies now that
done the course with you.
No, I don't
No,
actually.
no,
I was
no.
part of the first cohort, and I'm a little bit hurt when he said each cohort's better. And I was like, what are you saying?
You're the originals.
Yeah, we're
It's best to be first.
But I just want to go back to something when you said when recognising what a good investment
Good
comes
deal
with
is,
knowledge,
yeah.
what a good deal is. So I remember saying this to you, Scott, when we first met. He sent me the first one, and it was in Brisbane or outside of Brisbane or country Queensland or something like that. And then I was like, no, I don't want that. And then he sent me this one in Waterloo. And a year later, after I'd done the course and all of this, I was flicking through my emails and I realised I looked at the one that I'd rejected and I thought, gee, that was dumb. But I didn't because I didn't know. I was too scared to go into country. I wanted Sydney, but obviously I didn't have the knowledge back then to be able to compare what is a good deal.
Yeah.
So as now I realise that was a really good deal and I should have said yes to that one.
So I was going to ask you what you would have done different so far. So you would have taken that first deal?
Absolutely.
Over the one you took, or are you still
Yes.
happy with the one you took?
No, don't get me wrong, very happy with what I took. But
Yeah.
with what I know now, I think I would have taken the one that Scott first showed me.
Yeah.
Because it wasn't part of a strata. It was like
A freehold type
freehold,
thing, was it?
Yeah, it was a classic I want to buy in my own backyard scenario. And look, we got, I think, the best Sydney deal on offer within that whole quarter. Like we did very well getting that yield at that time. And but yeah, like you said, you could have taken that money and got 4 times the size in the outskirts of Brisbane.
Yeah.
Like again, it's each to their own. Like
But those deals still exist, right? So there's a third and a fourth and a fifth property on there.
Yeah, but I wouldn't have that.
No.
That deposit.
It's a big check, the first one, was
Yes,
it?
it was. Because I sold a residential
Yeah,
property to be
yeah.
able to do that.
Yeah, okay.
So, yeah.
Yeah. Well, thanks for coming on, Sarah. I think I'm very conscious that, like me and Scott come on this podcast and we're a couple of sort of like Anglo-Saxon blokes, right? You know, and I don't want that to be representative of commercial property investors, and it's not. It's a very diverse cohort of people who are creating wealth through property. So bringing someone in like yourself to come and have a yarn with us and chat with us sort of really gives insights into, you know, all people of all shapes and sizes are looking to capitalise on what is a great way to create wealth. So thanks for sharing your story. It's been
pleasure.
really insightful.
And I think, Scott, you said only 20% are females? Are women?
Yeah, only about 20% female. So, and that's why Sarah's story is so unique. I think even in your community, you mentioned how rare it is for females often to take control of their own finances. And so it makes the story super impressive. It is unique. And then it's even more unique because it's commercial. And then the dollar amount of it's more unique. And you're quite young for having to done all that as well. You won't find many stories like that.
No, you must be quite proud of this journey that you're on. That's by no means, you know, over. You sort of sounds like you've only just started.
Yeah, no, I sort of I feel quite humbled, and I think Rebecca shared me the brief, and I said that to my kids, and I'm like, they're making me look really good here. That's so embarrassing. And then my son, because I have my oldest son, he's in business, studying business law, and one of the good things has been able to bond. Explain to him what I'm doing, why I'm doing, talking about return on investments, advantages. It's been like a sounding board, and he came back with, "Mum, but this is you," and I'm so.
It was probably the best endorsement, right?
Absolutely. So it was great, and sharing this with my son and teaching him this passive knowledge is what like.
So is this going to be a thing for you guys? You're going to start looking at property together and doing it, which is really cool, right? Like,
Yeah.
And I think financial education should be born and cultivated at home.
Yeah, we should. Financial education should be spoken at home. We shouldn't be scared to talk about these things at home with your children. I was reading this terrible story the other day where this girl got a credit card and she thought she had free money and was spending it and not realising that was a debt.
Yeah.
Because it wasn't spoken about at home, that this is not a debt, this is a credit card and you're borrowing money.
You have to pay it back.
You have to pay it back.
It's like afterpay and all this sort of stuff.
Absolutely,
You know,
I was aghast. Like, how do people not know that? But it just goes back to what's taught at home. Yeah.
Well, we've set a new benchmark for guests, Scott, not to sort of sully all of our previous guests, but I don't know where we're going to go from here.
What do you
Give
reckon?
us some new
What's
homework,
next?
mate. I don't know.
Maybe put it to the listeners. Would love to get feedback on what's next, because hearing from investors was a big part of it. Got an economist before, so we're all ears, really.
Yeah,
But,
we are.
Yeah.
How do we work it out? Who should they contact?
Just email info@rethinkinvesting.com.au and any feedback on the course, the podcast. And I want to thank you, Sarah, for coming on board. It was a really interesting interview and been great to work with you as well.
Yeah, likewise.
And a shout out to Rebecca behind the scenes that does a lot of the heavy lifting as well. She's the unsung hero of this podcast. You may see her on camera one day. You never know.
Get her on one day.
But thank you. Thanks for coming in. Scott, good to see you, mate. Let's keep an eye on what's going on.
Sounds good.
I'll be picking your brain this time next month.
Look forward to it, mate.
Yeah.
You've got to go for round 2 soon, I hear.
Yeah, I know. I've got to sort it out. I bought an expensive resi property recently that chewed up a lot of capital.
You've done another holiday home.
Yeah, God, another holiday home. No, it's a struggling small businessman trying to get ahead, mate. That's what I am. But thanks for tuning in, everyone, inside Commercial Property. It was Scott O'Neill from Rethink Investing. I hope you enjoyed that. You go and Google these guys. You can probably the easiest way to find out what they're up to and get in touch if you want to sort of pick their brain and find out what next for you. Enjoy doing these podcasts. I must admit, I'm a lot more informed around commercial property investing than what I was 4 years ago. Is that long now?
Wasn't hard though. You were fresh.
But keep tuning in. There's a whole bunch of other episodes. I think this one is number 47. God, what are we going to do for our 50? Is 50 worth celebrating, or has it got to be 100 before we pop the
studio in one of your holiday homes?
Maybe.
Do it there.
Let's do it. Okay. Okay. Thanks for tuning in, everyone. We'll see you again next time, and then bye-bye.